And welcome to this session where we're going to look at and explore one of those new acronyms or fairly new acronyms that we've developed in the pensions industry over the last few years, as if perhaps we don't have so many already. But IRM, and what does IRM mean? What is our understanding of it? And how do we make it practical in use? And welcome to our audience online as well. So hello. We've also got a fair bit of interaction going on in this session. So we're going to ask you for some questions in a few moments. So please do use your app to respond to those questions, and the instructions can be popped back on screen. We'll also be asking you for feedback and questions later. So just take a moment or two to get used to those. And in this session, I am delighted to be joined by my panel of experts. Fred Berry from the Pensions Regulator, Sinead Leahy from PwC, and Kelly Davies from BAE. And we're going to discuss the issues from different perspectives and look forward to hearing your questions in due course. So get your app ready, and Fred, over to you.
Right, over to me. Well, thank you very much for that kind introduction. Clearly, I am here to give a regulator's perspective on integrated risk management, something which we appear to have created and added to the TLA lexicon about 3 and a bit years ago now. It's going to be a talk of 3 halves, just demonstrating I can't really do much maths, but it's going to be a bit of a little bit on background and our intentions in creating integrated risk management, a summary of how we think it's going at the moment generally, and to highlight 1 or 2 key issues which we would greatly appreciate industry's help in maybe getting your act together a bit better on. I'm not going to be doing all the talking. You will be pleased to hear, as Joe hinted, we have some interactive questions, and I believe if I work my way through this little clicky button thing, here is the first of the interactive questions. We thought it would be fine for me to stand up and say how familiar we think you ought to be, but we thought we'd ask you that question. How familiar are you with our IRM guidance? We've got a series of options of familiarity ranging from frankly profound ignorance through to, yes, read and loved all of it. And I believe the form is that I give you the opportunity to vote like now, and then something happens, and then I get the joys of trying to talk about the results of it. So please go forth and vote. Right, and if this is following the form I've seen in previous sessions, these numbers will jiggle around a bit, but yet told you, they've moved already. Certainly more people now willing to fess up to not such great familiarity, but really pleasing that we've got about a quarter of you aware that it does exist. We've produced some guidance on it, that's great. And then a good 2/3 of the audience, more or less, have either read some of it or all of it. Many congratulations to those of you who have read all of it. That's really pleasing, exactly the sort of message we want to get out there. I do sometimes wonder with an audience like this, some of the asset managers who just look after specific asset classes, I perfectly understand you're not being familiar with all of it. Others of you, like pension fund trustees, have no excuse whatsoever for not having read at least some of it. Anyway, yeah, good background. Thank you for that. Let's try and move on now to, I was going to ask anyone not familiar with this picture, but I thought that would be such a no-brainer. You've all seen that or some variation on it. This is the graphic we use to describe integrated risk management, the idea in principle of looking after your investment risks, your funding risks, your covenant risks, and that's the risk management bit of it, and integrated is doing it in a manner that is joined up. That's what integrated means. Sorry, it's statement obvious, but that's what it's all about. I said I'd give a bit of background to it. Where did it come from? It basically came from our 2014 revision of the code of practice we put out for DB scheme funding. The legislative background to that is that a scheme's funding should be on a prudent basis. Any recovery plan needed to get up to 100% funded should be appropriate. And our code was saying that all this should take place in the context of the best support for a DB scheme being a strong ongoing sponsor, hence the covenant bit of it. And it's, you see immediately there you've got the elements of the scheme funding level, you've got the sponsor covenant. It's also reflected in our own objectives as a regulator, where we are required to look after the security of members' benefits, the security of the PPF, but we also have to balance those when we're making regulatory interventions with the sustainable growth of sponsoring employers. So immediately, in just a very short explanation of what this is about, I hope you're beginning to appreciate that it is about balancing complementary, perhaps competing objectives. And that comes in with us as a regulator when we're intervening on scheme funding, and it comes in when scheme trustees are negotiating with scheme sponsors about appropriate funding plans and contributions, all that kind of stuff. So integrated risk management in the current regulatory regime, all about striking a balance between these things. So that was kind of how we were setting out the framework 3 years ago. And I said I'd move on to, well, what's the results looking like so far? And again, I'm not going to venture my view first. I'm going to take an audience poll. And we have another question for you to give me the opportunity to try and digest, etc. It's the how is it for you kind of question. How well do you think pension funds are actually getting on with this, doing it? And again, we've got a spectrum of answers from the most enthusiastic at the top. It's sort of you're fully embracing it, you think it's a really great thing, best things sliced bread, but we couldn't fit that on a board up there. Through to, yeah, okay, if we have to do it, we'll do it. And obviously no one's got to fess up in front of me that you're just paying lip service to it, are you? But let's see, anyone going to rise to that challenge? How about answering the question? Like, now. I'm waiting for someone to dare to answer D, and they're not going to. And if the people who've answered C would like to see me in a bar this evening, we might have a very interesting conversation. Maybe you're just playing devil's advocate with me for fun. But see, I knew someone would eventually. Shut up, you have your fun now. But more to the point, the serious bits of this are that I was very much hoping that the vast majority of these answers would be either the all-embracing A, we think it's great and wonderful, or the slightly more sceptical, but still very sensible, yes, okay, this is all scheme-specific, so let's adopt the bits of it which are going to work for us in our context, and let's not go overboard with it. Which, to us as a regulator, if that's right for your context, and when we look at it, we're satisfied that it's okay for your context too, that's fine. So I'm actually gratefully reassured by that, and while I've been talking, that D has crept up to 11%, and I don't like the look of that at all. I'm going to move swiftly on, take that off the screen and put the triangle back up. Because what I was going to go and say is that as far as we at the regulator are concerned, and we go out and talk to people and we look at schemes, casework, etc., we think we're seeing a mixed picture. There are areas of schemes doing it very well, and others, frankly, haven't really got round to thinking about it at all. And I was going to highlight 3 areas where we think schemes could be doing better. Some of them, there are those that aren't really even getting started at the moment. There are those that are doing some risk management but aren't joining it up. And there are those that are doing it, but they're not actually doing anything with the results. So to those of you who aren't getting started, I sometimes wonder whether it's schemes that are put off by the potential complexity of it, and think, oh God, this is too scary for us even to get to grips with. It needn't be. If you do read the guidance, we are trying at pains to say, look, start with something simple, some simple scenario analysis. Perhaps not the scenario that was suggested yesterday, the Black Death, though I did have some fun thinking about how Black Death might affect pension scheme funding, but just something simple. What might interest rates do? What might inflation going up do? What might a downturn in the economy do? So I say downturn, but this is risk management. We look at the downsides. What might happen if markets take a downturn? Just very simple scenarios like that. Think about what Brexit might do. Think about climate change, as was being discussed yesterday. I mean, that is a potentially significant risk in our view for schemes out there. And you don't need to be hugely sophisticated, don't need huge kit, don't need huge amounts of data, just to start thinking about the basics of that. And our concern is that many schemes haven't even, well, our concern is that there are schemes out there who haven't even taken a toe in the water and started thinking through those scenarios. It's easy enough then to think about how each scenario might impact investment individually, funding individually, covenant individually. The trick then is, as I say, to talk about joining them up. And I'm sure that Sinead and Kelly will talk about that later, and I'm not going to seek to steal their thunder now. It's also very important to us as the regulator to see that when schemes have done their IRM work, that they actually do something in consequence of it. It isn't just something you do and forget, put it in the cupboard and pull it out at the next triennial valuation. Very important for us to see schemes have contingency plans so that if risks do come home to roost, they've pre-agreed with the sponsor what they're going to do about it. In our view, an agreement just to have a nice conversation at the time isn't a good enough contingency plan. I mean, the ideal one would be some legally enforceable agreement. We accept that that ideal is often quite difficult to achieve, but something concrete. If X happens, then we will do Y in response is our preferred approach to that kind of thing. And it's also very important to monitor risks on a regular basis in between valuations. And you can probably expect us to be saying a little more about that in our annual funding statement when we publish that around early April, is what people tell me. So that's what we think of the results so far. I said I'd say something about what we think the biggest problem is, and I don't think I'm alone in reckoning that investment and funding have been fairly well integrated through asset liability modelling for a number of years now. The trick is in integrating the covenant into all of this, and again, I expect we will be hearing more from the consultants and scheme practitioners' view later. But it is interesting to us to see how the employer-trustee relationship can be helped or, dare I say, sometimes hindered by these IRM-type conversations. And again, I just thought I'd take a quick audience poll in terms of those of you who have experienced schemes going through an IRM process. What kind of impact is that having on collaboration between trustee boards and scheme sponsors? And we've given a spectrum there. There's neutral in the middle, there's significant improvement at the top, and again, I'm hoping no one's going to answer E, but go on, disappoint me, go forth and answer. I'm just waiting for some degree of stability to emerge in those results. And I think that's quite encouraging. I mean, really well done those of you who are able to answer A, that it's brought about a significant improvement, which I'm hoping is through effort, commitment on both the part of the scheme sponsoring employer and the trustees. Slight improvement, that's good, and no change is at least an improvement on the slight worsening which 4% of you are having to admit to. But again, I think in the round then those results bearing out our experiences there, that it is helping schemes sponsoring employers work more closely together. I was going to say a little about what we thought the biggest problem we are seeing is in terms of scheme covenants, and it's just worth noting, just drawing from casework that I've been involved in, that one of the best ways to annoy us as a regulator, if we're on your case literally, is to come in and say, we think our covenant is super strong. We've been around since, and then you pick a date 100, 200, 300 years ago, and just because we've been around since then, we're going to stick around forever. And I do sometimes wonder whether that is trustees who have good cause to believe that their covenant is strong, but they're ducking the tricky questions of thinking, well, okay then, something that's been strong in the past may yet fail in the future. How might it fail? What might the funding and investment be like in those scenarios of failure? So I'm just putting that out there. It's a basic question of, okay then, covenant strength at the moment, but will it be there when it's needed? And again, our regulatory preference for schemes whose covenant is strong and whose sponsors can afford to put the money in at the moment, kind of to fix the roof while the sun is shining, which after 2 pretty miserable days in Edinburgh, Monday, Tuesday, and don't let's mention last week, last time I looked, it is shining, on which point I'll shut up and move on. Thank you.
Sinead, great to hear your perspective.
Thank you. Thanks, Fred. So I'm going to try and give you some practical tips for actually adopting IRM. And I think that the key word is integrated. And I don't just mean funding, investment and covenant. I think the integration between the corporate sponsors and the trustees and the way they work together on this is actually really important as well. And I've been, I don't know if I've been surprised. I mean, judging from the results, I think it's true to say that a lot of the expertise, whether it's covenant, and we see some fantastic covenant work, some great, obviously, funding and investment work, still for a number of schemes operates in silos. And I'm often hearing that, you know, the covenant advisor has come in, but perhaps some of the investment people, the investment advisor hasn't really been involved, or the actuary on the scheme hasn't been involved in any of the discussions. And so they haven't actually sat down as a group of experts and talked about IRM with their trustee board. And I think part of the reason why that is difficult is sort of in my title here. Are all the disciplines actually speaking the same language? Can they really collaborate? And so at PwC, because we do have investment expertise, actuarial expertise for funding, and also covenant advisors, we've actually come together and said, well, can we create a common language? Can we come up with a simplified dashboard, a straightforward approach which gets everybody asking questions which link all the three areas together? And I'm going to talk about that in just a moment. But where do you start? And I think it's really obvious, but I think it's really important to start with the long-term objectives. And again, I still see situations when we're perhaps working with a corporate sponsor that they haven't really articulated to the trustee board where they see the long-term objectives of the fund. And in the same way on the trustee side, they have very strong views potentially on the long-term objective, and there isn't that linkage between where the trustees and the sponsor are going. There are definitely more joint working party groups being formed where you get a smaller number of individuals from the sponsor and from the trustees together trying to work it out. But I think we could probably see more of that. So starting, you absolutely need to be aligned in terms of the objective. So whether that's the plan to transfer the assets and liabilities to an insurer for a premium, as we've got here in buyout, whether it's, and some of you might say the second one is self-sufficiency. I've sort of taken that slightly to the next level and said, this is about not wanting any more cash calls from the sponsor and actually making sure that ultimately the assets you're holding will be there to pay the benefits. Or is it the last one, which I guess we don't see often as a long-term objective, which is very simply that let's not worry, the sponsor's going to be around and will provide long-term covenant support to sort of cover any shortfalls in funding. So where do you go once you've agreed your target? Well, what I said earlier about trying to have some kind of common agreement among the three disciplines. And we think it can be helpful to look at these three elements: time, risk, and cash. And because I've only got less than 10 minutes, and I know Kelly's got to speak in a moment, so I'm going to rattle through this fairly quickly. So I want to cover off these three elements and then show you very quickly a very simplified dashboard that I think you can use regardless of the size of your scheme. And then I'll show you some high-level model outputs as well. So let's start with time. And what do we mean by time? So obviously evaluating the strength of the covenant is key. But we don't just want that. I will put pressure on my covenant team to say, what actually is the time horizon of this sponsor? And you'll see when we come to the model in a moment that it's important to be able to map that time horizon of the sponsor in relation to the time horizon of the scheme, which is going to be very different, but importantly, how does that link to the actual funding plan? If we've got a short time horizon on the sponsor, you've got to make sure that's not out of line with your funding plan and your contribution schedule. And that really covers question 3 as well. The second point here is around timing of when you need to divest some of your assets. So this is all about understanding where peak cash flows are. So from an actuarial point of view, understanding the member profile and how that's going to move over time. What is the forecast for how members are actually potentially going to come out of the scheme, as well as the maturity of the scheme as it goes through time? That helps you understand the peak cash flow point and whether there are any potential liquidity crunches coming in the short term. From a risk point of view, I think it makes sense to take a holistic approach to risk. So absolutely, you need an in-depth review of the ability of a sponsor's capacity to meet any falling funding levels, but you need to get into the detail, I think, as trustees, around looking at the market cap, looking at how if you like, the risk appetite of the sponsor, looking at how that compares to both the deficit and the VAR and what the headroom is, and then saying, so how much headroom have we got and what scenarios perhaps should we run which could impact that headroom? Obviously, you need to understand risks, and and I think everybody in the room is fully aware of that. What sometimes isn't done, so the investment risk, longevity, interest rate, I would actually put liquidity risk in there as well, I think we all spend a lot of time on. What perhaps is less commonly done is maybe the correlation between some of the risks that the sponsor is running and how do those correlate to the risks that the scheme is running. Is actually the biggest risk the sponsor not being there, and do you fully understand what could bring the sponsor down? I think that's really key. And then finally, in terms of cash, I break this into 2 areas. And again, these are questions that I'm sure you ask all the time, and it's trying to bring all the areas together. Affordability is the first focus here. So how much cash can the sponsor actually afford? And what assessment can you genuinely make over the fund's lifetime? So when we look at affordability, we will analyse the key outflows of the sponsor. What's the debt servicing cost? What's the capex? What's the dividend policy? And then look at how much spare capacity there is. Because if there's lots of spare capacity, are you having a sensible conversation around making additional cash available in the scheme? And if for whatever reason, and we had a trustee chair dinner quite recently where we talked about IRM, and they were saying, well, that's all well and good, but we might ask for money and we might not get it. So if there is a lot of capacity, then there has to be the question of, well, in what situation will you give me more money? What are the contingencies? Is there something else I can have now if it's not cash? Is there something around security? So an open conversation between all parties, I think, can be very, very fruitful. The second point on cash is around liquidity. And whether the scheme has a liquidity crisis looming, and how are they going to ensure that they avoid being cash flow negative. And obviously we had a session earlier on this, and I think the point about not being a forced seller of assets is really, really important, and I know it's one that a lot more schemes are starting to look at. And that very neatly brings, I think, all the 3 elements in together under this cash point. So very quickly, just a couple of slides to go. This is a very high-level summary dashboard, if you like. It's looking at the key target is the scheme on track to meet its funding target? It's got a question around time, particularly looking at the time horizon of the sponsor. The risk is around risk tolerance and appetite, and I've talked about affordability and cash. So you should try and come, I think, to an overall conclusion, if you can, which is what's the probability of meeting member payments as and when they fall due, having looked at all these three elements. And I think this dashboard should have benefits both for trustees, giving more confidence about the long-term support from the sponsor, but also for sponsors, having greater certainty around their future contributions and the volatility of the scheme. It's also about identifying risks as early as possible, and I want to talk about that in a little bit just at the end. So we can't go through this in detail, but I think it would be wrong not to mention technology and how do you keep a track on it. So I'm going to just go through these 4 boxes really, really quickly. So top left is about focusing on time. There's a vertical line for where we see the time horizon of the sponsor and how that compares to the time horizon of the scheme. And then the green and red lines that you see, that's where the funding gets to 100%, both from a target and a TP basis. So a comparison of time. Risk on the top right is the holistic view. You've got the sponsor on the left-hand side in terms of market cap. On the right, you've got the deficit and the VAR, and you've got the headroom, and you need to think about what could impact that headroom. Bottom left is about cash and all the elements I talked about. What does the sponsor need to pay out from capex, dividends, etc., and what's left for the pension fund? And finally, bottom right, the liquidity point. What are the actual cash flows of the assets and how are they going to actually meet the liabilities? This is about helping you think about contingency planning, think about good governance, and also understanding where the stress points are and whether additional scenario testing is needed to help you get a better handle on those stress points. So that's some guidance on that, and I'm going to hand over to Kelly, who's going to do from a real-life example.
Thank you, Sinead. And whilst Kelly's making her way over, just to remember, we'll have time for questions hopefully in a few minutes, so please send through those in the app. We'll also ask the audience to do it in the traditional fashion and raise your hand.
Great. Thanks, Sinead. So I was just going to start by giving a little bit of background on our schemes, because I think most people know that we have one of the largest DB schemes in the UK, but what many people don't know is we actually have 7 DB schemes, and these range from a size of 30 million right up to a size of 14 billion. And all our schemes vary quite a lot in terms of their funding level, their maturity, and their benefit structure. But they've all got one really big thing in common, and that's the covenant. They're all sponsored by BAE Systems and have the same covenant. And so we've been carrying out covenant assessments since back to 2005, and it's become increasingly clear to us that because of this single covenant, it's really important that we think about this across the schemes consistently from a funding and investment perspective. So when the regulator brought out the guidance around IRM, actually it fitted really well with our thinking at the time in 2014 when we were working our way through our 2014 valuations. And one of our really key objectives in the 2014 valuations was to ensure consistency of treatment of the schemes because of the aligned covenant. And we took some steps on the approach to 2014 to align all the dates of our valuations, which may seem mad to choose to do all the valuations at one time, but actually a lot of efficiencies come from this and a lot of collaboration between all the trustee boards and the company as well. So moving on to how we approach IRM from a valuation perspective, first of all, we start off the process by assessing the covenant. And we do this very early on, before the actual valuation date, because it's such a key input to reviewing the investment and funding aspects of the valuation. And so a jointly commissioned piece of work is done across all our schemes to assess the covenant of the company. And our schemes actually work together through the most recent valuations, with the trustees forming a joint working group to receive the output of this covenant assessment and hear the results and discussion together with some of the sponsor in the room as well. And that's the way we run our valuations, very collaboratively across the various trustee boards and with the company involved as well. We've also made steps to make sure that the covenants are identical across the schemes by making sure they've got the same levels of guarantees and the same principal employers. So all our trustee boards really understand that they do have this common covenant. And then having assessed the covenant, we review the investment strategy. We look at things like value at risk of the investment strategy and make sure that from the output of the covenant assessment, it's affordable to be running that sort of investment strategy. And up until 2014, we had a range of investment strategies across all our schemes. But having brought all the schemes onto the same date and recognised the single covenant, we looked to have a common approach in terms of investment strategy across all the schemes. And we started with this in having a medium-term plan of getting to a portfolio of 70% in matched assets. And that was back in 2014. We then developed this further through the recent valuations by looking at the different maturities of our schemes. We analysed the cash flows and maturities and came up with a framework for assessing where our schemes are in terms of the journey of maturity and developing an investment journey plan to fit the different maturities of the schemes. So we've now got a common framework of investment strategy and maturity which we can apply consistently across our schemes. Then, having considered the appropriateness of the investment strategy linked to the covenant, we then move on to the real funding aspects of the valuation. And we look at the covenant assessment, and this is really key to the scheme actuaries to make sure that the covenant assessment is consistent with the level of prudence that they're advising the trustees to take as part of the valuation. And we primarily take this prudence through the life expectancy assumptions and the discount rate assumption. And in the discount rate assumption, we really look at linking the investment and funding strategy closely. And this is by setting the discount rate relative to expected returns on assets on the investments that were held by the schemes and the investments they expect to hold over the journey plan. And we improved the integration of the funding and investment through the discount rate further through our recent valuations by, instead of translating the expected return on assets back to a gilts plus proxy, we actually built up expected return formulas for the key asset classes and built these into the discount rate that we use in our valuation system to track the funding position. So that takes me quite neatly on to the monitoring aspects. And definitely for us, the valuation isn't it. We've got a very comprehensive monitoring process in place across all our schemes through a control panel that's looked at on a quarterly basis by trustees. And through the valuations, we make sure that the key metrics from a covenant investment and funding perspective are reviewed and that the advisors and trustees are comfortable with the level of reporting. From a covenant perspective, we monitor the key aspects of the covenant that come out of the assessment that's done on a triennial basis. And we also have the sponsor going to each of the trustee boards twice a year to report on the results. The investment metrics are looked at by the investment committees, things like the return, how they're performing against the discount rate, and also value at risk and other risk figures that are key to the trustees. And finally, the funding updates. We actually in-house have access to a tool which allows us to look at the funding update daily. But for the trustees, it's reported within their quarterly packs. It not only shows where they are, but where they are against the journey and where they were at the valuation, so they can track the position. And also looking at the probability of success of reaching their more longer-term targets through that reporting as well. We also have, from the 2014 valuations, made efforts to put in place flow charts which encourage discussion amongst the trustees and them to think about different actions they might take if any of the key metrics were off track. But we developed this further through the more recent valuations and put in place formal contingency plans which set out some key actions that would be taken if some of the key metrics were to go off track. So that's all I was going to say from the monitoring perspective. So just to conclude, really for our approach with a multi-scheme approach and a single covenant, IRM is very well aligned to how we operate our schemes and has worked very well for us. We started the journey back in 2014 and we've improved it through the 2017 valuations through a focus on a more longer term journey plan and a fully integrated asset-led discount rate. And we also fully reflect IRM in the way that we actually monitor the schemes on an ongoing basis through our control panel. So thank you.
Thank you, Kelly. So we have time for a few questions and many have come through on the app. Feel free to send a few more in. I'm going to take chair's prerogative and try and merge a few together so we can cover them. IRM has been a bit of a journey for schemes over the last few years. I mean, has the conversation changed much in that time period? And where do you see it going next? And will there be other things like technical innovation which will make it easier for schemes to use in a kind of proportionate fashion?
I think from our scheme's perspective, it really has developed since the 2014 valuations where we were just introducing the concept of IRM to the more recent valuations where it was already really ingrained into a lot of the thinking of the trustees and the company. So we were starting from a principle of this is how we work and how can we develop it as opposed to trying to put something in place.
Did it take you a long time to get there in the first place?
No, it didn't, but I think part of that was because our thinking had already sort of moved in that way because of the link with the covenants. Actually, the timing was really good from our perspective, so we'd maybe moved a little bit further before the guidance came out, and it was good timing for us.
First mover advantage. Yeah. Sinead?
Yes, so I think to answer your question around technology, I think technology is always moving forward. And I actually think there is an opportunity with IRM to very simply bring some of the concepts we've talked about. I think hopefully I showed some very simple inputs that you could put there, but actually the output trying to look at the covenant strength in relation to even the risks that the scheme is running and how do they compare to maybe the risks that the sponsor is running. I think there is a way that technology can help you do that efficiently.
Fred, I'm going to ask you proportionate. Proportionate means lots of different things to lots of different people. What does it mean for the regulator?
Yeah, interesting question. But as I was just thinking there in the context of one of the presentations yesterday, we live in an environment these days where there's an awful lot of data available, an awful lot of technology that can be used to harness that data and manipulate it, suck useful information out of it. And I put in a plea for don't forget just some of the basic principles, some of the really simple scenario tests which any scheme can apply. Yeah. And that if you're a really big scheme that's done lots of sophisticated stuff and still can't answer a simple question around, oh, what if rates go up or the economy goes down or etc., maybe you've got a bit drowned in your technology kind of thing. In a roundabout way, that's what I think of by proportionate. Don't lose sight of the basics.
Always a good thing. Don't forget the basics. I think we heard that yesterday as well. I'll open to the floor. Any questions from the floor? Let me see. So now the lights come up, we can see Robert. The microphone's making its way to you.
One of the issues with the integrated covenant with funding and investment is that you're always looking at the covenant of yesterday rather than the covenant of tomorrow, typically. In a period where the longevity of companies has got significantly smaller, is there a risk that you're not getting money off people when the sun is shining because they think their covenant's strong, and actually by the time the covenant's weak in an integrated model, there's no money to get?
Do you want to start, Fred?
Well, that's a yes-no question, and the answer is yes, there is a risk of that. That's something which we, as the regulator, do feel quite strongly about. I think you can expect us to say a little something about that in our annual funding statement in April. But yeah, I exactly take the point. Like with many things in life, the data you've got on which to make predictions about the future is of necessity past data, but I think it's pretty complacent of any organisation to think just because it's been all right in the past, that it's going to be all right in the future. It's probably been all right in the past either because of luck or because of good management actions, and maybe a good covenant advisor will be taking all those kind of things into account in working out a covenant rating for a company in the future.
Thank you. Anybody else?
Yeah, I wouldn't mind just coming on that. I think it's a really important point, and I was trying to make that point, and I've had long discussions. I'm obviously on the investment side, and I've had those exact discussions with our covenant colleagues. I want them to tell me what is the time horizon. And depending on the sector you're in, depending on whether you've got long-term contracts, you're going to have very different views on that. And I think we need to definitely not rely on past performance. You've got to have people looking at what are the sectors doing and where are they going in the future. And you need to try and put a time horizon on it. And we had some very difficult discussions when we were working through some of this commonality of language. They weren't used to thinking like that. And so I think we do need to work on that pretty hard.
So this is actually something that we thought about in our most recent valuations, and we actually asked the covenant assessment team to do a specific piece of work on the longer term covenant, so they were not just focusing on the short term, and they did this specific piece of work, which was for the first time actually done in 2017 for us.
Thank you. Any more questions from the floor? Gentleman here.
David Adkins, Lloyds Banking Group. I mean, what's the next evolution in integrated risk management? I mean, I can understand from the regulator's point of view that getting the majority rather than the minority doing IRM is its main objective. But for those who've already got the basics, what does version 2.0 look like?
Good question. Fred.
Oh, that's very kind of you. Yeah, I mean, I suppose what you're asking is where is the cutting edge likely to be going in the next couple of years? And I think one very interesting thing looming on the near horizon is, of course, the white paper and a proposed slightly different, more clearer, potentially tougher regime for scheme funding, which I'm sure will have some knock-on effects into schemes' approaches to integrated risk management. My personal view is that as the schemes that have been doing it at the kind of basic level get a better understanding of their basic risks, they will be able to drill down more into them, see more of the correlations. The modelling will become more sophisticated. One can expect consultants to be able to offer more sophisticated ways of looking at it and guiding their clients through the massive data to see what's really going on there as experience builds up. And I reckon there will be improvements made in linking the covenant with it, as Sinead has just been saying, getting covenant advisors to think in the same sort of time frames as investment consultants and actuaries, or maybe even persuading investment consultants and actuaries, I speak as both myself, to accept that sometimes you just can't see that far into the future and to just sort of get with the visibility the covenant advisor can provide.
Any further thoughts?
I think my only comment would be around because you can't see what's around the corner. You have to make sure that you've done your analysis for the what-if situations. And while you might not think that's going to happen, what's your contingency plan if it does? So are we doing enough analysis on what can go wrong? And are we being honest about what can go wrong? Not just from an economic point of view, but from a so within the pension fund risk, but also, you know, for many schemes, their biggest risk is their corporate sponsor. So are we really understanding what can go wrong with the sponsor and having contingency plans or agreements in place that additional security or whatever it is available under certain circumstances, but obviously not when it's too late.
Thank you. One final, good question here. That'll be the final question for the session.
Owen Davis, Russell Investments. My interpretation of IRM is to make trustees both aware of the risks which schemes are exposed to from the sponsor and the investment strategy, what might happen in the worst case scenarios, and broadly reducing risks, all the risks they're exposed to, but securing additional funding if required and reducing the risks within their investment strategy. There has been a move in the industry lately for more focus on cash flow driven investments. Some people have said we think LDI is overvalued. If the Bank of England does start to reduce the amount of gilts they hold, that could cause rates to increase. It looks like LDI is a bad investment. I just wonder what, from a perhaps regulator's perspective, what sort of interaction a scheme could expect with the regulator if they took a view that LDI was overvalued and then removed that from the portfolio.
Yes, I doubt the camera's going to pick this up, but some of us do a very good raised eyebrow at the regulator, by which I mean slightly more seriously. You're proposing a scheme increasing its amount of risk and placing a lot of its risk budget on a call on interest rate movements, which superficially to us would look like potentially two bad things. And then we will be having conversations along the lines of, well, okay, then, is the strong sponsor covenant strong enough to bear that risk? Have you perhaps got an agreement in place with the sponsor that if that interest rate view doesn't come good, that the sponsor will stump up the losses that the scheme incurs as a result of it? Because quite often in our experience, sponsors do tend to express those views and pressure trustees into taking interest rate positions like that. But yes, at the first blush, we would be a bit uncomfortable with that, particularly if it was a scheme which had got itself into a good funding position and was running the risk of maybe it going a lot worse if the rates don't turn out how you expect it to be, just on the off chance that it might improve a little on the back of the bet you're taking. So broadly speaking, uncomfortable but open to a conversation, I think.
Thank you.
Perhaps over coffee, which is where we're heading next. So I don't want to keep you too much longer. We've slightly overrun. So thank you very much. And thank you to our panel.